On October 19th, 1987, the entire global financial system pretty much stared into the abyss. It was a day that would go down in history as Black Monday. So in this explainer, we're going to unpack exactly what happened, why it all went down, and the really critical lessons we learned from one of the most insane days in stock market history.
So let's just start with a number that says it all, negative 22.6%. In a single day, the Dow Jones Industrial Average just cratered. To give you some perspective, that's the largest one-day percentage drop in the Dow's entire history, a record that, believe it or not, still stands today. It was nothing short of a financial earthquake.
And you can imagine that was the one terrifying question on everybody's mind, right? The memory of the 1929 crash was still very real for a lot of people, and they feared the absolute worst, a total economic collapse, banks failing, another decade of hardship. But that's not what happened. And figuring out why it didn't happen is really the key to this whole story.
To really get why this wasn't just a repeat of 1929, we first have to wrap our heads around the sheer, unadulterated chaos of that one single day.
I mean, it was just a waterfall of selling that seemed to have no bottom. You had investors just watching in absolute horror as fortunes that were built up over years just vanished in a matter of hours. The value of basically everything was plummeting, and that created this sense of pure panic that just kept feeding on itself.
So what on earth caused this financial tsunami? Well, it wasn't just one thing. Black Monday was really the result of a perfect storm, a whole bunch of factors that came together to create this incredibly volatile and unstable market.
You see, in the years leading up to '87, stocks had been on a tear, creating this kind of speculative bubble. At the very same time, you had interest rates ticking up, the US was running these huge deficits, and other markets around the world were already looking pretty shaky. But there was a brand new and really powerful ingredient in this mix: technology.
And this is where things get really interesting. We see a new player on the field, the computer. This thing called program trading was basically designed to automatically sell stocks when the market fell by a certain amount. The whole idea was to limit losses for big investors, but what it actually did was become a massive gas pedal for the crash. This is the perfect way to picture the chain reaction. You get a small dip in the market, and that triggers these pre-programmed sell orders, and we're not talking small orders. These were huge, institutional-sized sales. This giant wave of selling pushes prices down even further, which of course triggers even more automated selling. It was this vicious, self-feeding cycle that humans just couldn't get a handle on. It was moving too fast.
Okay, so this is the most crucial part of the story.
The crash was absolutely terrifying, no doubt, but it didn't spiral into a decade-long depression. So let's dig into why 1987 was so fundamentally different from 1929. This chart right here tells you almost everything you need to know. Back in 1929, the Federal Reserve basically sat on its hands and did very little to stop the bleeding. But in 1987, it acted, and it acted decisively. And look at the economy. In 1929, it was already weak, but the economy in '87 was actually pretty strong, with solid corporate profits and inflation under control, a totally different backdrop. This single statement from the Federal Reserve, led by its new chairman, Alan Greenspan, was a total game changer. And this wasn't just talk. The Fed immediately started pumping money into the banking system. Why? To make sure banks wouldn't fail and that credit wouldn't completely freeze up. This one action was probably the most important thing that prevented a much wider economic catastrophe.
So when you boil it all down, the market had just gotten way ahead of itself. The crash, as brutal as it was basically a violent repricing of stocks back to more sane levels. Because the underlying economy and corporate earnings were still healthy, there was a solid foundation for a recovery that just wasn't there back in 1929.
Now, the recovery was actually surprisingly quick, but the shock of Black Monday led to some really fundamental changes in how our markets work. It left a lasting and I'd say vital legacy. It's safe to say nobody wanted to go through that kind of uncontrolled freefall ever again. Regulators and the stock exchanges themselves realized they needed new tools to handle this kind of extreme volatility, especially when it was being fueled by high-speed automated trading. And one of the most important innovations to come out of the crash was this: circuit breakers. The best way to think of them is like a mandatory timeout for the entire market. If things start dropping way too fast, trading just stops for everyone. It gives people a moment to breathe, to digest what's happening, and hopefully it prevents that emotion-driven panic from spiraling completely out of control. So when all is said and done, what are the big takeaways here? Well, Black Monday was the stark reminder that new technology, like program trading, can create brand new unforeseen dangers. It proved, without a doubt, the critical role of a central bank ready to step in during a crisis. And for investors, it really hammered home those timeless lessons about managing your risk and, most importantly, not panicking during a crazy downturn.
The 1987 crash was really the first major crisis of our modern computerized financial world. It forced us to build new safeguards, new rules of the road. But today, our markets are faster, way more complex, and more interconnected globally than ever before. So it really leaves us with this one critical question. Have the lessons of Black Monday truly prepared us for the next inevitable crisis?